Welcome, everyone. It's 12 p.m. on the East Coast in the United States, and I know there are many people from outside of this time zone. Why don't you just share with us in the chat where you're based, where you're coming in from? I know there are some people from Japan and really committed to hear from Sandra and from Stu. So thank you, everybody, for being here. My name is Michael Pearson. I'm the president of the International Humanistic Management Association, and we have committed to these sessions that we call the intellectual shaman sessions, that are basically faculty development sessions, where Sandra Waddock, our esteemed colleague, is hosting conversations with people that she admires and considers leaders and guides in the field of academia, but also beyond. So with that, Sandra, I just want to thank you for hosting this, and I invite everybody to just share with us where you're based, and yes, enjoy the conversation that she will have with Stu Hart. So thank you, Stu, for making it. Over to you, Sandra.
Thanks, Michael, and welcome everybody. I love doing this series because we get to meet and talk with really great folks like Stu Hart. And I'm just going to do a brief introduction of Stu. He is currently professor in residence at the University of Michigan's Herb Institute for Global Sustainable Enterprise, having tried to retire multiple times. And he's just founded a new initiative that he'll be telling you a little bit about. He was the founder of the Herb Institute's dual master's program in the early 1990s, and is clearly a pioneer in bringing the ideas of ecological sustainability into the whole business arena. He has worked at University of North Carolina's Keenan Flagler Business School and Cornell's Johnson School of Management, where he's currently the S.C. Johnson Professor Emeritus still. He was professor in Stephen Grossman Endowed Chair at the University of Vermont's Grossman School of Business, where he founded and planned and organized and developed their new Sustainable Innovation MBA program. Stu is a pioneer in more ways than one. He's one of the global authorities on the implications of the natural environment and poverty for business. If you've heard of the bottom of the pyramid, that's because of Stu. If you know about business needing to be more sustainable, that's largely because of Stu and some of his colleagues. His book, Capitalism at the Crossroads, published in 2005, was selected by Cambridge University Press as one of the top 50 books on sustainability of all time. And his new book, which is what we're going to hear a little bit about today, is called Beyond Shareholder Primacy. So Stu, welcome. Over to you. Oh, let me just share a bit about the format. So Stu will present for 25 minutes to a half hour or so. And then I'll ask him a couple of questions, and then please put questions that you might have for him into the chat, and I'll try to organize them and call on people, call on you to unmute your Zoom thing and show your picture and ask Stu your own questions, but please do that. So use the chat to do that. Okay, Stu, over to you. Oh, and mute yourself. Please mute yourself while Stu is speaking, if you can.
Sandra, thanks so much for that really very generous introduction. I appreciate that, and it's great to be with everyone. Yeah, as Sandra said, I think what I'd like to try to do today is give you maybe a little taste for this new book, Beyond Shareholder Primacy, but also say a little bit about a new initiative that has sprung, at least in part, from this work. And my colleague Fred Keller's on the call, so maybe we can hear a word or two from him as well a little bit later. But so let's get started with that agenda. And a big part of this work was, sort of historical. I became increasingly distraught, at sort of where things had come to, and felt that it was incumbent upon me to learn more about the history, right? And to understand how we could have possibly come to the place that we're currently in. So the historical journey kind of took me back. I ended up going back 400 or 500 years, and along the way kind of encountered, came to the realization, as I'm sure many of you already know, this is not exactly the first time that concerns about shareholder first, profit maximizing business and capitalism has been an issue. There have been plenty of people who have commented about this going back hundreds of years, which was actually very interesting to read about. But I would say probably none of them more eloquently than Louis Brandeis. So I just want to start off with, I think, this wonderful quote that I think he kind of sums it up, right? That in the field of modern business, so rich in opportunity for the exercise of man's finest and most varied mental faculties and moral qualities, mere money making cannot be regarded as the legitimate end. I mean, it's just, I really think that's it, right? That to have, people that have so much capacity be focused on the most simple-minded, single metric, single objective, it's a terrible underutilization of people's mental capacities. And I think Brandeis kind of hit it really well. And so this notion of kind of shareholder primacy as a real concern, as a real limitation, not to mention as the damage that it can do, has been around a long time. But it seemed also important to me that before we start talking about that in more depth, that it's important also to actually be clear about what shareholder primacy is, because it's one of those terms that gets thrown around a lot, like a lot of sustainability language. The terms get thrown around and no one's really quite sure, exactly what the other person is talking about. So I thought I'd take a minute and just do that, right? So at least my conception of what shareholder primacy is, I see it as a system, right? That it really is a system. It's certainly an economic system, but there's also a political order component to it as well. But at the center, of course, is the prime directive of maximizing shareholder value as the primary, if not sole purpose of the company, right? That's why it's called shareholder primacy. But I think that alone doesn't really tell the whole story. Equally important is understanding what the drivers of shareholder maximization are. And for that, it's all about quarterly earnings growth as the main driver. At least it's been that way for the last 30 or 40 years, and I'll talk more about that. And that furthermore, thanks to our friends at the Chicago School of Economics, we have a set of assumptions about human nature and about managerial behavior that suggests that they're kind of selfish, people who are behaving with guile to line their own pockets. So we've got to carefully monitor and control them and tie their comp to stock price. So executive compensation tied to stock price, I think, is another big piece of that puzzle. So it's this sort of trinity, I think, is the core of shareholder primacy, but it has all kinds of knock-on effects, that I think are important for us to recognize, that these things are all tied together. Because if these three really are at the center, then it just sort of follows that the company's attitude would be to lobby for deregulation, privatization, and globalization, because of course that opens up more opportunities for driving quarterly earnings growth, right? And driving executive comp by creating more things in the private sector, by shedding regulations, and by expanding globally. But then, the other piece of the puzzle to that is that driving quarterly earnings often can mean a focus on expense reduction. So how can we extract raw materials, or at least kind of secure them at not full cost, or outsource or limit worker pay, or reduce R&D, or squeeze suppliers? I mean, this has been sort of the hallmark of what's now being called Welchism, from the 90s and early 2000s. And then after you do the quarterly earnings reports and the analysts are happy, then to further goose the stock price, then you would direct the majority of the profits to dividends and share buybacks in order to drive the stock price even further. So 40 years ago, 50 years ago, less than half of profits were devoted to dividends and buybacks. Today, on average, it's now over 90% for publicly held companies in the US, which is staggering when you think about it, but it very much goes hand in glove with the reducing expenses piece. And since most people that own stocks, right, in other words, the people whose shares are being valued, tend to be the wealthier 10%, right? As shouldn't come as a great surprise. And in fact, once again, the wealthiest 1% own the vast majority, but 90% of the stocks are owned by the top 10%. And that furthermore, more for the last, 40 years or so, financial assets have grown much more rapidly in value than just wages or GDP or anything else. For working people, wages have been flat. So I'm not telling you anything you don't already know, but I think it's important just to understand this as a system. And, executive comp being kind of now out of control the way it is, sort of 350 to 1 ratio, whereas 40 years ago it was more like 35 to 1. Clearly that serves to widen the income divide as well, not just the wealth divide. And then lastly, when you lobby for deregulation, privatization, globalization, it follows that there's a focus on externalizing negative impacts, right, which also helps reduce cost, whether it's in the form of emissions or plastic waste or ecosystem degradation. We could go on with the list, right? But so this is the system that, as I see it, right, kind of the shareholder primacy system that we're talking about. And it's pretty clear that the shareholder primacy system, as it's in its current incarnation, right, which, as I say, has a lot to do with the Chicago School of Economics, kind of set of theories and assumptions. Hence, it's only 40 years old, at least this form of it, has certainly elevated a lot of people out of extreme poverty, at least as defined by the World Bank, in terms of, income poverty. But I think, as I need not lecture all of you on the call about, kind of what the downside has been, that we have, an accelerating climate crisis, a sixth extinction, and peak inequality, and so forth. So I need not kind of belabor that any further, because I think we all know that too well. But what I would like to spend a little bit of time on is the fact that for many, especially I would say people in business schools, and especially business school students, but I'd also say a lot of business people, think that this is the way it's always been, right? That the way it is now is the way it's always been and the way that it was meant to be. When, if you take a deeper dive into history, you quickly realize that that's not the case at all, right? That this kind of shareholder primacy form of capitalism is not preordained. It's even different in other parts of the world today, I think, as everyone on the call knows. But if you go back in time, you realize that capitalism has gone off the rails before, right? In fact, I argue in the book at least twice before, where there have been wild swings, right, in terms of how capitalism has been practiced. Periods where it goes wild with animal spirits, only to be sort of pulled back and tempered by our quote better angels, at least for some period of time, right? So I think it's important to recognize that, because at least for me, kind of coming to understand that was hopeful, because I think for a lot of people, they get discouraged, kind of looking at where things are now and the trajectory we're on, and don't think it's really possible to ever really turn the corner. Whereas, I think not only is it, but it's happened before. Maybe not in the fullness that we need, but it's happened before. So I wanted to kind of start that. I'm going to spend a little bit of time on the history part before talking, about the larger implications for today, because I think that's important. The book obviously there's a practical side to the book too, in terms of corporate transformation and institutional change and system change. But probably today we'll focus mostly on for the book, at least the historical part, and then we'll tell you a little bit about this new initiative, right? That springs at least in part from the book. So start with a question, right? At least to kind of get the juices flowing. What's the world's largest, most profitable, longest lived multinational corporation in the history of the world? And you need not answer out loud, but just mull it over in your mind for a moment. Maybe, maybe you're thinking Standard Oil, or GM or IBM, or I don't know. Those would probably be some of the companies that people would come to mind, or maybe it's Meta, but obviously that's not the longest lived. So you can think of companies that might fit some of these criteria, but not all of them. The largest, most profitable, and longest lived. When you consider all those things together, there's only one answer, and the answer is the British East India Company. Followed closely by the Dutch East India Company, but that was founded 2 years later, right? So the British East India Company was founded in 1600. And the British East India Company was the world's first joint stock limited liability corporation financed with private equity, which at the time was called adventure capital. interestingly enough, because of course it was the age of exploration. So why not call it adventure capital? And you know, that company and all the trading companies like it were founded for one purpose, which was to maximize the value for the shareholders. And it was really the source code for shareholder primacy, right? This is where it began, because certainly there had been, kind of large enterprises of conquest and so forth in the past, going back thousands of years, but none of them kind of marshaled through this kind of organizational form designed specifically for that purpose, which is what the British East India Company was. And and it had some very interesting impacts. It was exceedingly large and profitable for a long time. At one point in the 19th century, it accounted for half of world trade, right? And, I mean, it enforced its will with a 250,000 member private army. So it was a business model of extraction, of subjugations of local people, and then externalizing negative impacts. That's really the source code for the sort of extractive shareholder primacy capitalism that we know today. It's the source code, and it had some fairly pernicious effects, right? So in India, where it was perhaps reached its peak, it had the effect of, at least, well, initially starting in the 1600s, not so terrible, right? Sort of buying finished Indian textiles, which were the highest quality in the world. India at the time was far advanced to England. 100 million people in India in 1600 versus 3 or 4 million in England. India accounted for probably a quarter of I don't know how people cook these numbers up, but the estimate is that India and China together are about half of world production, India a quarter. And it was a much more advanced society by far, right? The English were backwater at the time, but also, had an army, had an attitude, and had a corporate form, and then later had technology in the form of the steam engine, right, and power looms that changed everything, right? Such that it moved from sourcing finished goods and selling them to basically putting all of those out of business and sourcing raw cotton for the purposes of making those textiles much cheaper in England and selling them back, to the Indians, buying finished product and using them to buy slaves, right? That was really the model. Such that over the 240 years or so that the British East India Company was dominant in India, by one estimate, actually by several, but this is sort of the central figure, the estimate is that it extracted somewhere in the range of today's dollars, $45 trillion from India, right? And it succeeded in basically impoverishing the country and creating the conditions that we discovered it, kind of following independence. That was really the effect. And that model, of course, was then moved around the world, including the New World, right? British East India Company had a major impact on the New World. The New World was settled by trading companies, British trading companies. The Massachusetts Bay Company, the Virginia Company were all the same model as the British East India Company. The British East India Company was the company that was bringing the tea that got thrown in the harbor in Boston. So that there's a long arc of impact here over time. And so, this notion, this kind of mercantile capitalism, which the trading companies really were the source of, corporate tyranny and imperialism, produced ultimately backlash. The backlash in India came only much later, but it came in the New World in the form of the American Revolution, right? The colonists sort of got fed up, not just with the king, but also with these corporations that were systematically preventing them from making things, here in the New World. Rather, the British wanted to extract and then sell back and prevent, right, the development of indigenous industry. That was really the source of the American Revolution, right? And the intellectual force behind much of that was the Scottish Enlightenment, right? With certainly a range of philosophers, but one of the most important ones for our purposes being Adam Smith, right? That the Wealth of Nations was read widely by the founders, along with other Enlightenment philosophers. And his work, of course, was, I think is today misconstrued in a pretty substantial way. Whereas if you go back and read his original work, which I've done, and then read, the endless interpreters of him over the years, there's such a range of interpretations. But the most popular one these days is that he was the father of capitalism, right? And he was the father of the free market and so forth, which is not what he was saying at all, right? I mean, that's a perversion of what his message is. In fact, Adam Smith in many ways was the first anti-corporate revolutionary. He hated the trading companies. He railed against them. He was opposed to slavery. He thought monopolies were an aberration, right? And detested the idea of accumulating wealth. That as he put it, people that would accumulate wealth and buy baubles and trinkets, right? His view was that what the purpose of profit was to reinvest in the business so that you could hire more people and expand the business and build the commonwealth. He believed in virtue, right? And in the classical notion of virtue, and that business people should behave with virtue, which meant that they should be interested in mutual benefit and the common good. And as you know, if you read his work, including the theory of moral sentiments, it's not hard to realize that even the kind of the harsh interpretation of the invisible hand, even if we practice the invisible hand with business people behaving with the kind of virtue that he advocated, it just might work. Right. I think the realizing kind of the underpinnings of this is important, and what it produced in America, at least in the 19th century, early part of the 19th century, was a form of sort of the market economy that most of at least the northern, more industrial part of it. I'm not talking here about the slave South, but the industrial part of it was small companies, mostly sole proprietorships and so forth. Very few corporations. Corporations were carefully controlled, but that, of course, eroded over the course of the 19th century with the advent of the railroads and industrialization. And lo and behold, before we know it, by the late 19th century, we revert right back again, right to the source code with monopoly capitalism, with the Gilded Age and so forth. And I'm not going to go into depth here, but this was sort of the second movement of the source code, right? Kind of back to industrial trusts and monopoly control and labor unrest and so forth, and environmental destruction, everything that went along with that, only to see another counter movement, right, in the form of the progressive movement in the New Deal, which I kind of chronicle in the book, which produced a version of capitalism in the post-war years that CEOs like the CEO of IBM and General Motors themselves called welfare capitalism. And it was motivated by work like that of Adolf Berle and Gardner Means, right? To probably not household names these days, but at the time when their book came out in 1933, they were hailed as the next Adam Smiths. I mean, it was seen as that significant. And it's so interesting. If you haven't read Berle and Means, you should read it. Because if you know agency theory, Berle and Means argue exactly the opposite, right? Their take on the modern corporation was that here we are in the late 20s and 30s, after the Great Depression and the onset of the Great Depression, after the stock market crash and the onset of the Great Depression, and they come to realize that here we have these large corporations now with a lot of small shareholders. The tycoons had passed from the scene, and these large corporations are now being run by managers, right? Managers mostly trained in business schools that were founded by the tycoons themselves, both to skill up the managers, but also to train them in the ethics, because business schools in the early days thought that ethics were important if you were going to preserve social legitimacy and not be broken up by the progressives. And so the Adolf Berle and Gardner Means conception of the corporation was that, thank God, these companies are now finally being run by professionally trained people with ethics. It's a chance for these companies to really serve the common good for the betterment of the world, which is exactly the opposite of agency theory, right? When you think about it, because the agency theory views managers with sort of a shady view, right? That they're out in it for themselves, they're out to screw the shareholders and so forth. So we have to tie comp to share price. The opposite view, right? It was a very optimistic view of the role of the manager in the corporation. And as they said with the shareholder, they, in their terms, their own words, they invest not, they manage not, nor do they accept liability. So why should they receive the lion's share of the returns? They should receive, in their words, the shareholders, the wages of capital. That was their term, the wages of capital. So it was a completely different conception. And those years, my childhood, is what built the middle class, right? They were rewarded for things like promotion ladders and competitive pay and so forth. There were rewards for that. Lots of blind spots, I think, as we all know, things like environment, women, race. I mean, lots of blind spots. That's what a lot of the 60s protest was about. But the fact remains that that form of capitalism, there was a different operating system and a different objective function, only to give way once again, right, starting in the 70s with the Chicago School, to the current iteration of shareholder primacy capitalism that we're still living with, right? And I see what's going on, kind of our world, right, of sort of the environmental sustainability, equity, inclusion, whatever terminology you want to use, is the third counter movement, right? It is the pushback on this. And what we see emerging, albeit with fits and starts, I believe, is what will eventually become a sustainable form of capitalism, where I would hope we're able to actually edit out the cancer genes this time, not just suppress them only to have them arise again, right? And so that's what my new book is focused on, is focused on hopefully that journey. But I'm a realist at the same time, and I realize that it's been, I've been at this 30 some years and we haven't really gotten that far, that we've sort of been stuck in incrementalism, especially with big companies. The best we've done, is greening, and waste reduction and, and maybe now these days a little bit of sustainable sourcing and some pie in the sky goals, for 2050 without any real great plans to get there. So I sort of wonder, after 30 years of doing this, is the sustainable business movement broken, right? I mean, because this sort of incrementalism hasn't really moved the needle in any significant way. All the dials, in the world dashboard continue to head in the wrong direction, such that we don't really have any on-ramp and any on-ramp left, and for me at least, that, and I think for probably most of you on the call, it became sort of obvious to me a while ago. I mean, I wrote this piece, Beyond Greening Strategies for a Sustainable World. I won't give the date away right away, but it won the McKinsey Award that year, which I won't divulge. But here's a quote from that paper. I just wanted to read it quickly. The distance we've traveled will seem small when in 30 years we look back at whatever the decade is. Beyond greening lies an enormous challenge and an enormous opportunity. The challenge is to develop a sustainable global economy. Greening has been framed in terms of risk reduction, re-engineering, or cost cutting. Rarely is greening linked to strategy or technology development. The achievement of sustainability will mean billions of dollars in products, services, and technologies that barely exist. I think with a few changes, like a different date and maybe billions should become trillions, we could republish this today, and this was published in 1997, right? And the problem is, we really haven't done this, right? I mean, we've known we should be doing this now for going on 30 years, but we haven't. We just haven't done it. We're still stuck in incrementalism. And that's our challenge, right? That we have run out of on-ramp. There's really very little time left, right? That we've crossed the proverbial Rubicon at this point. So, it's incumbent, it's like, a five-alarm fire that we move from what I call these strategies for greening, which are about incremental improvement to existing products and processes and suppliers, so forth, kind of the win-win, leverage existing companies, continuous improvement way of thinking, to what, for a long time I've called beyond greening, which is about focusing on new leapfrog, regenerative, sustainable technologies, creating new markets that might even fulfill new unmet needs of the underserved with new and different partners and stakeholders in a way that can be net positive to build. It's going to require new competencies and kind of reinvent the entire system. Because I think our problem is the reason we haven't moved to beyond greening is because the rules of the game of capitalism itself for publicly held companies almost prevent it from happening. And that's our problem. And that's what the book is about. And that's what this new initiative that Fred, who's on the call, Fred was the founder and CEO of Cascade Engineering, and he and I have known each other a long time. we've been kind of dabbling at this now for a couple of years. And the idea here is to try to launch, I suppose, what you'd call a movement of movements. And I'll briefly describe it and then stop because I realize we're already at 12:30. Bringing the world inside is what we're calling it. Maybe Fred can comment a little bit too if we have time. But we started with sort of the maybe the framing that we need to reimagine this whole notion of externalities, that this is maybe a good entry point for thinking about a movement like this. Because, externalities as an idea, we still use the term, it gets thrown around a lot, but it's a century or more old, right? It was probably best summarized in Pigue's book, The Economics of Welfare, 100 years ago. Back in the days of, the dark satanic mills, with belching smokestacks and muddy streets and so forth. And the externalities in those people's mind were what we would think of today as scope 1 and 2, right? They were very proximal, very facility based, very company based. So it made sense then, a solution was to force producers to internalize the social cost, to tax them or regulate them, right? And most environment, sort of the whole field of environmental economics still is premised off this way of thinking. And that made sense, right? For those types of waste and emissions, that sense made sense because you could, quote, internalize the externality that way. The problem is externalities have become much more complex and widespread in the ensuing 100 years. We're sort of at a point now where the externalities themselves, if you try to monetize them, are on the scale of the market, right? That market failures are as great as the market itself and have become much more widespread. They're not localized like, back 100 years ago where you could solve problems this way. So, so Fred and I, our mantra has been, maybe it's time that we focus on the externalities as the enemy, not business or business people themselves. There's still a tendency to want to vilify business and business people when they're not the enemy. The enemy are the externalities and the system that enables them. So, our first step was to try to develop, a kind of a framework for thinking about this. So this notion that they become more complex and widespread. And so we put together another simple-minded kind of 2-axis chart here where, the ones down in the lower left quadrant, they're lower costs for companies and more simple, less complex. Well, these are things like production waste and direct emissions and, living wage and scope 1. These were the original externalities, right, from 100 years ago. And these are, kind of this is scope 1 and 2 stuff, right? We know how to deal with it. But then there's kind of another, kind of tier out, which would be things like supply chain sustainability and racial and gender equity and greenhouse gas emissions out to scope 3 and plastic waste and spent product. This is our bleeding edge of where we are right now with scope 3 and double materiality and so forth. And this is challenging us, right, in a pretty significant way. But then there's a whole nother level of externalities like inequality, poverty, climate change, microbial resistance, habitat destruction, species loss, so forth. These are mega problems, right, that in some cases are global in scale, that are interrelated themselves, right, like climate justice, right? I mean, you can't really separate these things, and you certainly can't pin these on individual companies. So the old way of thinking about externalities, where we try to focus on companies and force them to internalize externalities, is just not going to get us there. That we somehow have to match the strategies we undertake have to match the nature of the externalities. So when it comes to these near-in ones, right? Yeah, these, this is sort of our sweet spot. Win-win works here. You can make the quote business case for sustainability, which is code for not negatively impacting short-term profitability, right? That's really what proving the business case means, right? That it doesn't violate the Friedman doctrine. And that's why we've been limited to incrementalism. So this fits within the current operating system and metrics of shareholder primacy, which is why that's what's taken off. Greening still rules. But then when we get out, to scope 3, transforming the whole value chain, this is more complex. It requires collaboration. We need metrics with maybe longer term success metrics, maybe a different operating system. It tests the limits of shareholder primacy. We're living it right now, right, with scope 3. But then when you get out to these scope 4 and 5, as I call them, kinds of externalities, shareholder primacy just almost prevents the serious confrontation of these kinds of things, that we have to move beyond shareholder primacy if we're going to actually deal with the systemic problems and institutional redesigns that are going to be necessary. So we need to catalyze a whole new objective function for capitalism, and that we as business professors, as business leaders, as business people, probably have to be the ones that take the lead in making that happen and being the source for it. But also to realize, as Fred and I have gotten into it, and I should also mention that Sandra has been closely involved in this initiative, and we'll talk more about that. That we're not the first ones to come to this realization. We recognize that these are not all new ideas, and that there have been plenty of initiatives started already that are out there, in some cases that are thriving. And so the whole idea, as Sandra talks about in her book, is we want to connect with them, right? Cohere with them, amplify them. And so we, again, being kind of strategy kind of people, come up with a simple-minded 2x2 that some of these are more answer-based, where they come with a prescription, here's what you need to do. Others more creating inquiring systems. Some are more firm level and focused. Some are at the system level. So, that's the idea that, kind of system level questions gives you one type of initiative, system level answers the 4 quadrants. So we just populated it with a few examples, in the firm level answer-based, things like science-based targets or ESG ratings or B Lab, becoming B certified, so forth. Question-based, or more inquiring systems like conscious capitalism or Trellis or WBCSD and so forth. At the system level, where there's more prescription, things like system change investing or the Democracy Collaborative or Systemic or Shareholder Commons, long-term stock exchange. And then on the question-based side, things like Donut Economics Action Lab or Wellbeing Economy Alliance, so forth, Imagine, Imperative 21, and this is where we would position what we're trying to do with bringing the world inside, being very much, we focus on the firm level too, right? That's our model of the externalities that includes the range, but we think where we really get traction is at the system level, but not coming with answers, really sort of trying to engage and inspire groups of people to try to tackle this and come up with new approaches, to be truly, as Sandra calls it, transformation catalysts, as she describes so well in her new book. So just to close, I'm almost done, Sandra. What we're trying to do, I think, which maybe sets us apart a little bit, is to focus, to have a particular focus. That so much work around this has been focused on large global multinational public companies. That's certainly where a lot of my life has been. And the problem is, we now realize clearly that they're shackled by shareholder primacy, which means they're stuck in the win-win space. They just are, endless conversations with CEOs that will tell you, and Fred can tell you, they just feel hamstrung, right? And they know they're not making the right decisions for the company or the world, but they're worried about, activist investors taking them over and so forth, And then we also spent a lot of time on the other end, like really small companies, kind of, B Corps, right? And startup world and, impact investing, all important, right? I think that's important too. But, in some ways it's so small that it's hard for it to move the needle in the time frame that we have. So our focus is on medium-sized privately held companies. And it turns out, that unsurprisingly, this is sort of the heart of the real economy, that from Dave Stangus at Apollo, we see that 87% of US firms generating more than 100 million in revenue are privately held, right? And they account for 80% of the new jobs. So if we can, and these are companies not hamstrung by shareholder primacy, right? That the business leaders, properly motivated, can pursue long-term transformational agendas because they can, right? And if they band together, they're big enough to try to influence kind of partners and policy. We could have real impact here. So this is what our focus is. And we're looking to build a CEO-led movement, right? Where first we kind of build this new framework to reframe externalities as I've just described. Then the idea is to build kind of a learning engine where we bring together cohorts of business leaders, CEOs, academics, people from civil society and government as necessary, and others, to work, in concert in learning labs to create learning systems to develop new approaches, innovative approaches, and try them out and evaluate them and see what works and what doesn't. To catalyze learning labs all over the world, maybe focused on different geographies or on specific new opportunities and issues. To have it be that sort of, we need hundreds and hundreds of learning labs where, we could serve to try to connect them together and to assemble the innovations as they come forward into an open innovation platform, and where we engage, the people involved in this, and then serve as a clearinghouse, even a digital clearinghouse where appropriate, for new approaches, strategies, and initiatives that might have the chance to really get after these externalities as I've just described them. So I want to say we held an initial gathering of which Sandra was a part. You can see some names on the left-hand side at Cornell Tech on Roosevelt Island back in November. It was I think, a productive meeting. We're off to a good start. We'd love, if you're interested, to join with us. So definitely let Sandra or me or Fred know. Post. And I just wanted to end with an appropriate, proverbial benediction that I think, just like Brandeis's quote, sums up our challenge and opportunity. And it's directly from Mark Carney's book, Values, which some of you, I'm sure, know. And he tells a story in the book about a dinner that Pope Francis hosted at the Vatican that he attended for business people and people in the financial industry especially. And he kicked off the dinner with a few remarks, and here were his remarks. He said, "Our meal will be accompanied by wine. Now, wine is many things. It has a bouquet, color, and richness of taste that all complement the food. It has alcohol that can enliven the mind. Wine enriches our senses. At the end of our feast, we will have grappa. Grappa is one thing, alcohol. Grappa is wine distilled. Humanity is many things, passionate, curious, rational, altruistic, creative, self-interested. But the market is one thing, self-interested. The market is humanity distilled. Your job is to turn grappa back into wine, to turn the market back into humanity." That's it. Thanks.
Thank you, Stu. Wow. I have about a million questions, but there's some really good questions that are popping up in the chat. So I'm going to turn it immediately over to people. And if we have time at the end, I'll come back to my questions. So Brad Miller, you've been very active. Can you please pick one question and please try to be short because there's not a lot of time left and we want to get to as many as possible. Are you there? You can unmute yourself and ask whichever question is most pressing.
My apologies. I had a problem unmuting myself. Good evening, everyone from The Hague, and Happy New Year. Thank you, Sandra. Thank you, Stu. I have made one question, which is in regards to the fact that in a world of 8 billion people, the loss and damage is in the so-called global south. So my question for Stu was, I really liked his comment about utilizing resources being of service to humanity. So my research is focused on translating global realities into local concerns. And my suggestion is that business school students utilize their resources there with the loss and damages in order to balance the gap between the global north with our economies, which is causing further damage. So in order to minimize the risks, I think that our focus and our business school students should be there where the damage is. In Rotterdam last week, I shared this thought and they were very excited. They came to me to congratulate me for the 7 years that I have spent within the Embassy of Bangladesh, one of the most affected countries when it comes to climate breakdown.
Yeah.
So the response was very positive.
Is there a question, Red Muller?
So what is your thought about my idea about redirecting, utilizing resources there where the problem is?
I couldn't agree more, right? And a lot of my the focus from my work for the last 20 years, plus has been the idea that we can that the global south is where, where the bulk of the impacts occur, that, and so it's the poor that get the short end of the stick almost all the time. And it's also the place where we could stand up, first, the truly sustainable and regenerative solutions, and a better and a more sustainable way of living first, right? That it's much harder to have people unlearn in the developed North the old way, to unlearn the old ways and adopt new ways. It's far easier for people who haven't already been trained to think in a certain way about consumption, to leapfrog to something new. So that's been kind of a core thought of mine. I totally agree with you. And so for bringing the world inside, the learning lab idea would be, we need a lot of learning labs in the global south, right? Because that's where I think where the most innovative ideas can spring from.
But what I'm working on is that the embassies around the world become those learning labs, because governments, they will not go anywhere, whether it's Trump or anyone else
Oh,
who
no,
comes
these are
to.
not governmental. No, these are not governmental. The learning labs would be, yeah, go ahead.
Yeah, but my suggestion is that actually we utilize government organizations and bring students to embassies so that they can analyze the business case about the consequences when the climate refugees come into their countries where they are going to go back or where they already are.
Embassies could be interesting, as kind of sources of, like you're saying, that it gives you a window on what the problems are. So I hear you, absolutely.
Thanks.
I don't want to take up too much time. Thank you so much, Sandra.
Thank you. So I had a question that came in before the session from Robert Sroof, who couldn't be here, but we'll listen later. He wants to know, in the book, you talk about capitalism being remade twice before. What has changed recently, our current time, that will cause capitalism to be made anytime soon? And picking up on one of the questions that's in the chat, and especially given in the US today, and the rightward turn elsewhere around the world, given the political climate?
Yeah, excellent question. Yeah, no, I think, again, if I kind of, if history instructs us in any way, it's that, these kind of, there are tipping points, right? There are kind of points at which, as I talk about in the book, there was, at least in the previous two, there was some kind of motive force, but also there was an intellectual stimulus at the same time, so if you think about the American Revolution, that was the motive force, the actual revolution, but the intellectual force behind that was the Scottish Enlightenment, and the Enlightenment thinking. That informed the founders. Obviously, that didn't trickle down to the people that fought the revolution, right? But that the founders were informed by that, and the message that they brought resonated with those that fought in the revolution, right? That so-called rabble. So there was always, a motive force and an intellectual stimulus. Same thing, with the move to welfare capitalism. It was the Great Depression. It was Keynesian thinking, right? And it was the Second World War that tipped us into a completely new form following the Second World War. I guess my view is, as I wrote the book, because it came out, obviously, going on a year ago, my hope was the sort of the constellation of things like COVID, the meltdown that followed COVID, and all of the challenges that we face in terms of the climate crisis and so forth, were sufficient, to catalyze this. And we certainly have plenty of intellectual stimulus. We're not lacking for that, right? As Milton Friedman says, when the crisis comes, when the change comes, usually the ideas put into play, or the policies or the actions put into play, come from ideas already laying around. That's a Milton Friedmanism. And he's right, and I think we've got plenty of ideas laying around, but I guess we haven't reached the point yet. There hasn't been sufficient perturbation to produce the sort of counter movement in force. I guess we need more pushing. I talk about in the book the idea of the Jungian idea of enantiodromia, right? Where things go to extremes only to turn into their opposites. And I guess we haven't been pushed yet to enough of an extreme.
Thank you. Jean Stead, you have a question. Hi, Jean. are you in a car? Can you,
He's in a car. Hi, Gene.
yeah, can you unmute?
Yep, there you go.
What? No, you're remuted.
Yep, remuted.
Remuted. There you go.
Hello.
Hey,
Hello from East Tennessee. I'm in a car.
hey, how you doing,
And
Gene?
and one of the things too that seems to me, because what happened in East Tennessee with Hurricane Helene is a turning point, and so we're seeing turning points and turning points.
Yes.
To me, your sustainability capitalism must be couched and embedded in ecological economics, and we're still teaching neoclassical closed system economics in business schools, and the self-interest, all of that, and until we shift to an open system model where externalities are accepted and are not external, I don't see how we can possibly move in
I
your
could, again,
vision.
could not agree more. And one of the chapters in the book is reinventing business education. And of course,
Yes,
it's been a personal mission for me, but I agree with you. I think in terms of systemic root causes, business education is probably one of the most important, because
I
it's an
agree.
institution that enables and defines capitalism. And unless or until we creatively destroy the MBA as we know it, we're doomed.
So,
Thank you. Guillaume, you have your hand up? Guillaume?
Yes, thank you. Thank you very much for this presentation. Thank you very much, Stuart and Sandra. So recent research has shown that, especially in large companies, efforts done to reduce environmental impact is insufficient. Environmental impact actually increases over the years in super large corporations. Recent research also suggests that a solution seems to be to include externalities within the business model, which is also at the core of a business's strategy. So my question to you, Stuart, is how does this notion of integrating externalities or caring for externalities within the business model, how does it resonate with the presentation that you made today, especially going beyond shareholder primacy and creating learning spaces for managers? Thanks.
Yeah, no, thank you for that. I think it's directly in line, with not only the thinking in the book, but also the bringing the world inside notion that Fred and I are putting forward. That, I mean, what you're describing is exactly what we need, right? That what's needed is for externalities to be brought, not using the term internalizing externalities, but rather that companies think about they become worldly corporations, such that they think about their entire footprint as part of what they do in the world, not seeking to extract and externalize. That those very concept of externalities needs to be eliminated, right? We shouldn't be talking about externalities. That business should henceforth think about itself in its totality, just as you've described it. But if we're going to get there, the success metrics for companies need to change, right? So, in the book, I have a chapter called Redefining the Meaning of Value. And I think probably most of you would agree that in the public equity market, over the last 40 years, public equity markets have become entirely trading markets, right? 40 years ago, they're like maybe a quarter of what the New York Stock Exchange did was new issues, new investment. But now with deregulation and derivatives, 99% plus of the transactions for the New York Stock Exchange are just share trades. It's trading. And then there's maybe 300 billion a year, right, in IPOs and SPACs, but there's $1 trillion a year in share buybacks. So the share buybacks swamp the new investment, so that something like the New York Stock Exchange actually extracts capital, doesn't contribute it. It's a pure trading platform. And if that's the case, it's a secondary market. And we could decide it could be anything we want that would drive the share price. It's just the fact that quarterly earnings growth has been perpetrated on us as the way that share price is driven is just a story, right? It's a narrative myth that comes to us courtesy of the Chicago School of Economics. It's not written in stone. It wasn't always that way, right? Even going back to the 50s and 60s, different drivers drove stock price. This sort of the style of shareholder primacy capitalism driven by quarterly earnings growth is 40 years old, right? So it's well within our power to change it. So what we need to do is redefine the drivers of value such that companies are pulled to become global citizens, that they think about what they do in the world in its totality and are rewarded for it. That's the name of the game. That's what bringing the world inside represents.
There's so many good questions. Teresa, I know you have more of a comment, but if you could make it short, that would be really helpful. Teresa, you still here? Maybe not. Teresa?
Yes, I'm here. I apologize. I think for me, it was just mainly a comment. It was, I'm sorry, I'm based in Medellin, Colombia. It wasn't necessarily a question. It was just a comment regarding here in the global South. I think what you were saying before, Stuart, is a lot of communities, they don't see economy as a strictly like economic growth driven activity, whereas they see it like, for example, in Cusco and in the Quero tradition, they mainly see economy as sumak kausai, which really focuses on living well within the community. And it also includes a lot of the concept for the Andeans, which is aini, which is reciprocity. So it was just kind of a comment on here in the global South and South America. That's a lot of the times the way that they view, I mean, they don't even usually use the word growth. They usually mainly focus on living well and well-being. So it was just mainly a comment. Thank you for
an important comment. Right?
Unfortunately, we're running out of time. So we have, I think, time for one more question. Petra, Molten Hill, would you like to ask your question? There's so many good questions in the chat. It's hard to get to them all.
Can you capture those, Sandra? We can.
Yeah, we'll see.
Yeah, that'd be great.
Oh.
Hello.
If I figure out how to do it.
Hi. Actually, my main question is because I have lots of questions actually in my head. I think it's a transformation from whole industries, because for me, I think it is really a problem that we have to transform fossil fuel industries, and obviously, where would you fit this one, Stuart? Within your whole framework and so on, what we need to change there, because we just can't keep these industries going as they are, kind of. So how can this change happen?
Critical question. You know, I think
And there are several other questions along those lines, Stu.
Yeah, there are so many entry points and angles and leverage points. One of them is industry. You know, I think, as you say, for sure, and you know, but there are also other ways to come at it that could affect, say, the fossil fuel industries without a direct focus on just fossil fuels. So I think as part of our initiative, we want to stand up kind of learning labs that engage people in creative thinking about new approaches from multiple angles, one of which could well be industry focused. Because I hear you, but I think the practice of trying to confront the fossil fuel industry directly with the message that it needs to be shut down is probably not well received. So I think at some level, we also have to be creative in our thinking about where we can get leverage for change.
Well, thank you, everyone. Stu, I want you to know this was one of the biggest attended sessions we've had. Thank you so much for a really outstanding session. There's a number of comments in the chat that indicate that. Anyway, thank you. Thank you, everyone. Happy New Year. And Michael, hopefully you can save the chat because I'm not seeing that function on my screen here. So,
thank you, everyone.
and there are plenty of other questions in the chat, but thank you again. It was just a terrific session.
Thanks, Stu.
Thank you.